You ever wonder what it looks like when a whole economy collapses so badly that it feels like someone pressed a giant reset button? What happens when the money that once built cars and houses and futures just disappears? That's not a hypothetical anymore. And the lessons in this story matter for anyone chasing money, stability, or business growth in America or Canada. Today we're digging into the Venezuela story, not as a geography lesson, but as a real to-do with power, money, and strategy. And stick around, because by the end you're going to see this is not just about another country, it's about how you think about your own financial decisions, market risk, and long-term planning. Imagine this, a nation sitting on the largest oil reserves on Earth. That should be a billionaire's dream, right? But what if I told you that kind of wealth can actually be a trap, not a treasure chest? That's exactly what happened to Venezuela. Back in the 1970s, Venezuela's per-person income was on par with middle-class Europe. It funded infrastructure, it funded jobs, it lifted millions out of poverty. And at that moment, it looked like an unstoppable story of prosperity. But then came the critical business decision, one that should make every CEO, every startup founder, every corporate strategist in the US and Canada sit up and pay attention. Instead of diversifying the economy or building buffers, Venezuela doubled down on oil as the only engine of growth. That sounds familiar if you've ever seen a company get addicted to one revenue stream, one product line, or one big client. In business, we call that concentration risk. In Venezuela, it became existential risk. And if you think poor planning and risk concentration only show up in boardrooms or startups, think again. By the 2010s, oil production had fallen off a cliff while costs and government spending kept rising. The government kept printing money to cover gaps, and that sent inflation into a tailspin most Americans can barely imagine. This wasn't a 5% inflation year like in the US in 2021. This was hundreds of percent. And at times it topped hundreds of thousands percent. People needed wheelbarrows of cash just to buy basic groceries. But let's slow that down. For someone budgeting rent in Phoenix or a mortgage in Calgary, this business story has a deeper undercurrent. When your income sources are narrow and tied to one volatile commodity, you trade long-term stability for short-term liquidity. That's like building a business that only sells to one client. If that client walks, you collapse. Venezuela didn't collapse overnight. It eroded over decades. GDP per person today is a fraction of what it was at its peak, and millions of Venezuelans have left in search of opportunity elsewhere. Now, a lot of people online like to point fingers at external forces like sanctions or global politics. And yes, sanctions, especially after 2017, magnified the pain by cutting access to markets and credit. But even before that, the fundamentals were failing. Venezuela became so dependent on oil that when production dropped, there was nothing to fall back on. That's like a technology company that never innovates, then wonders why its sales crash when customers start shifting platforms. Let's take a closer look at what went wrong from a business strategy perspective, because this isn't abstract. First, the government nationalized industries and interfered heavily with markets. Price controls, national ownership, and legal uncertainty scared off investors. Anyone with capital to invest outside the oil sector stayed away. Corruption became endemic, and by some measures, Venezuela ranked near the very bottom globally in business transparency. That means the risk of doing business there wasn't just economic. It was legal and reputational too. That's why this lesson hits home even for entrepreneurs in the US and Canada. You can't build a growth strategy on one core revenue engine and no plan for diversification. You can't depend on external capital once your internal functions start failing. And most importantly, you can't ignore market signals in favor of wishful thinking, whether you're steering a country or a public company. But notice something here. This doesn't end in doom. There's a deeper insight buried under all this chaos. In business, when something looks like a train wreck, it's often because somebody ignored early warning signs. In Venezuela's case, declining oil production, rising inflation, shrinking GDP, and capital flight were early red flags that could have been addressed with structural reforms. Instead, they were denied until the system cracked. And when it cracked, it did so hard. That's a lesson in risk management most CEOs learn only after a major downturn. We call it leading indicators, and it's something every business leader should track. Now you might be thinking, okay, but how does this translate to my life? Real answer, it's about financial resilience. Whether it's your business, your investments, or your career, having multiple income streams, emergency liquidity, and an honest assessment of market risks matters. People in Venezuela watched their savings evaporate because decisions were made with ideology, not economics. In the US and Canada, too many workers are one job loss away from financial stress. Too many businesses are one client loss away from bankruptcy. The Venezuela story proves that concentrated risk is dangerous at any scale. Here's another part most people don't realize. When trust erodes, whether in a government or a brand, everything else collapses faster. Once the currency loses credibility, once companies stop investing, once talent starts leaving, the whole environment becomes hostile to growth. That's like when key employees quit a startup and suddenly morale tanks. The business doesn't just lose staff, it loses momentum. It loses future. Venezuela lost human capital on a massive scale. Millions of people with skills and ideas moved abroad because there was no pathway to stability at home. And that's not just sad, it's a business lesson. In the economy of opportunity, people go where growth and stability live. That's true in Silicon Valley, Calgary, New York, and Toronto. When a city or a company stops offering growth, the talent leaves, and with it goes the future. Before we go deeper into how this all plays out and what you can take away from it, do yourself a favor. If this kind of real strategic insight is the kind of thing you want more of, like this video and subscribe to the Boardroom Files so you don't miss the next piece in this kind of real-world business breakdown. It's not just theory, it's inside thinking that influences investment, corporate strategy, and personal wealth decisions in the real world. All right, let's continue. When the economy collapses, people don't just lose money, they lose confidence. Market confidence is like consumer sentiment in business. It's intangible, but it drives every decision from investment to hiring. In Venezuela, confidence cratered. Companies stopped expanding. Foreign partners pulled out. Banks tightened lending. And ordinary people began hoarding what little stable currency they could find or moving abroad to send money back home. That ripple effect turned a recession into a generational economic scar. If you run a business here in North America, ask yourself, are you tracking your leading indicators? Are you diversified enough to withstand client churn? Are you maintaining investor and customer confidence through transparency and reliability? These are the same principles that keep healthy economies growing and unstable ones imploding. The real turning point wasn't just declining oil prices or sanctions. It was the collapse of trust and diversification. Once that happens, whether it's a company or a country, recovery becomes not just hard but slow and painful. And that brings us to the real actionable insight. Resilience beats perfection every time. In business, you don't need a perfect plan. You need a robust plan that works when things go sideways. You need margin, flexibility, and multiple revenue engines. Because when the storm hits, the companies with the broadest base and the strongest fundamentals are the ones that survive and thrive. Now here's the payoff I promised earlier, that psychological loop from the start where you had to know why so many of these mistakes compound. Now I want to hear from you. What early warning signs have you seen in your own work, your industry, or your personal finances that others missed? Drop a comment and share your story. And if you know someone who's making decisions without thinking about diversification and risk, share this video with them. It might save them trouble down the line. Thanks for watching, and I'll see you in the next deep dive where we unpack another business story with lessons that matter.